in July of 2013, we were 38 million in revenue. So a little over 12 years ago, 38 millions to 5 billion, 900 plus acquisitions in 24 countries. Because, if you look at, we didn't spend a penny, not a dollar, and there's no exaggeration, no embellishment, not a dollar on marketing until 2022. And so in terms of the brand, Acrisure and all of that, it was that model that started in 2005 up till 2022 was still being deployed. That strategy was still being deployed.
Hi, everybody, and welcome back to the Entrepreneur Studio. And we're in season 4. And this season, we're going to talk about what it really takes to move your business forward, your team forward, and how to grow as a leader along the way. Today, we've got Greg Williams in the studio. He is the founder and CEO of Acrisure, somebody that I've gotten to know really well over the past few months. Greg, welcome to the Entrepreneur Studio.
Great to be here. Thanks for having me.
Glad to have you. Acrisure is a fintech company that has, really over 900 acquisitions since 2013. It's a 19,000 person and growing company in multiple countries, doing over 5 billion in revenue. So, you got to tell me, what gave you the vision for building this company?
Well, you know what? I got introduced to the opportunity in 2004. And it was when it was presented to me by my co-founder, Rick Norris. When it was presented, it was my initial reaction is the world doesn't need another insurance broker. I'm not sure if this is a good idea.
Yeah.
And the more I thought about it, the more it was discussed. It was really a situation where I wanted to spend some time analyzing and understanding the opportunity because the financial fundamentals were so sound and frankly kind of compelling and exciting. When I say that, it's a business with high recurring revenue, nice profit margins, low CapEx requirements. So financially, it was kind of an interesting opportunity. What did it mean and what did it represent in terms of market and how fragmented is the market and all of that? I didn't have any understanding of. Quickly ascertained that because there's a lot of information out there. After understanding that, started looking at, who's achieved some scale and some size and how did they do that? And you look at organic growth, it's call it, mid-single digits. You didn't get, the large-scale companies didn't get where they did because of organic growth. They got there through M&A. Yeah. And so there was a compelling opportunity for that reason, a highly fragmented industry, compelling financial fundamentals, a competitive subset, if I can say this without being demeaning in any way. But I looked at those who were building and scaling and growing, and I really felt like we could compete with them and offer the marketplace an opportunity and an alternative that would be pretty attractive. And so really what I came away with, while the industry or the world didn't necessarily need another insurance broker, the industry did. And it had to have an M&A model that was differentiated. It was one of those situations where what differentiated us also made sense from a business standpoint. And so we're able to build something that's now been copied many times in terms of buying and not rebranding and leaving businesses intact, not only brand, but leadership and not changing how people are paid. Basically, the stability of the business post-acquisition was something that we focused on heavily in the very beginning. And believe it or not, in the early days, it was a heavy buy, rebrand, change leadership, change compensation models for sales professionals and the like. And it introduced a lot of chaos into a business that's otherwise very predictable.
Yeah, that was producing.
And so anyway, so it was, we became known for, if you wanted to monetize some of the interest or some of the value you'd created over the years, we were known as the party, look, I can go monetize this value without having my life turned upside down, without creating chaos and disruption inside my business. And frankly, right down to the relationship I'm going to have with my employees that have helped me build this business, all of those things really were untouched and respected and celebrated and embraced. And again, believe it or not, you look back, that actually differentiated us. And So we kind of, as a lifestyle business, from 2005 to 2012, bought 26 companies in Michigan, Indiana, and Illinois. I went from knocking on doors to my phone was ringing to say, hey, we've heard what you did with, these folks, and we know them, and they're very happy they did a deal with you. And so 2013 was the kind of the catalyst in terms of when you say what changed from the early days to really scaling this. I went from knocking on doors to my phone was ringing kind of off the hook. And so that was the universe speaking to me a little bit about, hey, there's an opportunity here that's bigger than what you thought it was.
Yeah.
Maybe you should go pursue it. So that's
awesome.
kind of how it all got started.
Give us a quick profile of who these business owners and what the sort of type of business that they were running, just real quick for people who aren't familiar with insurance.
Yeah, in the early days, it was property and casualty insurance brokers and employee benefit to some specialty in terms of insurance brokers. And in terms of a profile, and as we scaled and grew and started, kind of stitching product and services and clients together, we got this, unbelievable growth that came out of all of that. And as you started getting, better sensitivity and better insight into client needs and things of that nature, and what we could now, if we're going to invest money, what could we add to the mix in terms of talent and specialty, marketplace dynamics and so forth in terms of industry, covering industry, certain industries, et cetera. As we were doing all that, you get that kind of expansion, wild expansion that, I think about this in July of 2013, we were 38 million of revenue. So a little over 12 years ago, 38 millions to 5 billion, 900 plus acquisitions, in 24 countries, because if you look at, we didn't spend a penny, not a dollar, and there's no exaggeration, no embellishment, not a dollar on marketing until 2022. And so in terms of the brand, Acrisure and all of that, it was that model that started in 2005 up till 2022 was still being deployed. That strategy was still being deployed.
Yeah. So, all the horsepower was in the acquisition. The amount of acquisitions per week, thinking about 900, that is staggering. It's staggering the amount of, and if you've never been through that, right? Talk about the art of a deal. Give us kind of the stages of how a deal goes, how long it takes, because I really think people need to understand the size and scale of 900 buying companies, 900 of them in a 12-year period, right?
Yeah.
So help us understand a little bit about what's the art of the deal, what are the stages of a deal, right? And things like that, so that people kind of get an idea of what this thing looked like for you guys.
Well, I think first and foremost, it kind of goes back to that the compelling financials that the fundamentals and the financials around the business that are so compelling. And when I say that, in order to do this kind of scale in terms of M&A, you have to attract capital first and foremost.
Yeah.
And so you can go sell an idea about it, anything. But if it's not found to be as equally as compelling as you think it is, capital is not going to, invest in it.
Yep.
So we had, a 250 year, it's 300 plus years in terms of the industry. In this country, it's 200, almost 250 years. Mm-hmm. And so, you had an industry that was tried and true, proven, high recurring revenue, all of those things that had the components and elements that an investor and investors and lenders both liked. So that starts with focus on something. If you're going to go build it, that the world is figured out as a safe haven or a place that you can invest capital with some degree of predictability and safety. And so that it starts with that, but then you kind of pivot into what's the fragmentation. I talked about that. I think in 2005 when I first started looking at it, there was something like 35,000 insurance brokers in the U.S. alone. Fast forward tens of thousands of deals that have been done. We've almost done 1,000 ourselves. There's still 25,000. If you fast forward 20 years later. So it's still a very highly fragmented. Now it's changed shape. It used to be, not very many deals, kind of a pyramid shape, if you will, very few large deals. And then, kind of cascaded down from that. in terms of the shape of the industry, size and scale, and what that looked like in terms of shape. It's now got an hourglass kind of look to it, to where there's significantly more scaled businesses. The compression and all the M&A is taking place in the middle, and so that's now compressed. And then where there's been rejuvenation and regeneration and so forth, that tend to be in the smaller, where people have left larger firms and hung their own shingle and started their own shop. That's where the kind of the opportunity exists in the much smaller marketplace. And so when you look at all of that, this industry had of those kinds of dynamics, attractive to capital, highly fragmented, people that had really not gone out and differentiated themselves in a way that was going to be sought after in terms of high degrees of enthusiasm. I used to say, I wouldn't say it to the extent I did then, but I used to say, an M&A transaction in the insurance brokerage space was a good day for the owner in terms of the seller, the entrepreneur that owned the business, and that he or she put some money in their pocket. It was not necessarily a good day for the business or the people that worked in the business. And that's kind of changed as time, and I think we had a little bit to do with that changing, that dynamic, is that focusing on this highly fragmented business that had entrepreneurs that for the most part were looking to monetize, but not sell and retire. That's opportunity as well that I think that we took advantage of, and others are still taking advantage of to this day.
That's awesome. So if you were to write one big check for all 900, how much money has been spent to buy all these companies?
Well, we've got, you know what, Chris, that's a great question. I should know the exact dollar amount off the top, but it's somewhere around $14.5 billion.
Wow.
that we've raised to go build this business. So when people say, hey, what you've done, it looks pretty easy and it's a lot of work. Well, you first got to go raise $14.5 billion. Be smart in how you're deploying that capital, because unwise investments get discovered by investors and lenders pretty quickly in terms of if you're not deploying capital the way that you should. Prioritizing, what you're looking for, the criteria that you have in doing M&A, and I would implore anybody, if they're going to deploy an M&A strategy in anything, have some defined criteria of what's a fit and what's not a fit, and be very disciplined about when it doesn't fit inside that box, know enough to walk away. And there's a few other things that you got to kind of quickly say we're walking away when it doesn't have these dynamics as well. So so all of that kind of comes into play as doing a scale M&A opportunity with any kind of significance to it. It's those things are all important.
Yeah. So it seemed like if I were to just describe it simply, you were building two capabilities at the company. The first capability was this sort of acquisition, M&A engine. And then the second capability is this deep knowledge of insurance, right?
Yep.
And so talk to us a little bit about, and you guys are just flying all over the country, raising capital and then figuring out how to deploy it in sort of these meaningful, predictable, types of businesses. The second capability of this depth in insurance, right? Starting off property and casualty and employee benefits and some surety, that sort of footprint has grown and evolved, right? Yep. So talk to us about that point of evolution where now you've got sort of the M&A engine going and you've got other opportunities that are adjacent that you're like, I think it makes sense to start expanding this other capability, which is the type of business that we're running.
Yep. Well, a couple things that are important in there that you're as you're talking and asking questions, nostalgic moments and things are coming to mind. But when you look at you keep just doing this, raise money, buy, and not connect all of these pieces and parts. Could you? Sure. Is there massive missed opportunity in that? Yes. And so as we were doing all of this, and I've said many lessons learned throughout the building of the business. One of them is the significance and the power of aligned interest. Relationships matter, alignment matters, high character people matters, and when you've placed an emphasis on those things first and foremost, and have a business strategy that you're building where, to the outside world, this looked like we were just buying, I think it was 2015, 56 companies. In 2016, it was 64 companies. 2017 went up to 92 companies, and from 18 to 22, we were never less than 100 in any given year.
Yeah.
And so the outside world is like, wow, this is kind of unimaginable growth. Maybe even viewed it as, gosh, is this reckless? And the reality is, approaching now, I think it's a little over 90% of every M&A deal we've done has been on a referral from an existing partner.
Oh, wow.
And so this wasn't, we're out talking to a bunch of people we don't know. This is
You're not prospecting.
It's not investment banker roadshow and bake-offs and, here's 12 companies bidding for one and you just happen to bid the most and you got it and all that. We were getting introduced to opportunity by our partners, back to that alignment and relationship. We're getting introduced to opportunities by our partners that they knew well. We're very transparent about the criteria we were looking for in terms of financial metrics, leadership metrics, cultural expectations. I don't know if I can say this in a taping like this, but we had a no assholes rule, and it just says, hey guys, I don't care how good the business is. If the person that's leading it's a jerk, I don't want them.
Yeah.
And so we had those kinds of things, and so our partners, you kind of like-minded people know, who looks like them and who, culturally has their same, integrity standards and expectations and so forth. So our partners are, you said, who's the hero in this story and all of that? It's frankly the partners that, as they became part of Acrisure, understood that, look, some of the expectations is, yes, just keep growing your business. Some of the expectations are introduce us to those that you know. And so when you look at that, I used to have bankers all the time would say, and investors loved it. Bankers would ask questions about rating agencies the same, where they'd say, how do you do 100 deals a year? I said, that's part of the right question. The real right question is, how many deals are we looking at a year? Because 100 sounds like a lot, but when you realize we're talking and meeting literally with over 1,000 a year,
wow,
suddenly 100 deals a year is not all that, it's not like we're just out recklessly buying stuff to buy stuff. We're literally looking at 1,000 companies a year in those heydays where we're doing 100 deals a year. We were looking at 1,000 opportunities. So our hit rate, close rate, whatever you want to refer to it, was literally about 10%.
Yeah.
One of every 10 businesses we looked at, we actually acquired. So the kind of the unsung hero in all of this is our partners aligning around what we're trying to do and build, understanding as shareholders in particular that as we achieve that scale, it was going to be something that was value creating to them. We had the ability to go out and raise money. They understood that. They didn't understand how we did it, but they understood that we knew how to do it. And so that it was kind of that symbiotic relationship that existed between partners. So we'll do what we're really good at, you do what you're really good at, and in the middle will be some magic. And so that's kind of how this whole thing came together and how you got that kind of scale and did that number of deals.
Yeah. I love hearing that. Before we talk about, how the fintech story started to emerge, you got to tell us, you're flying around on a jet. What is the wildest thing that you can remember? What's the wildest story that you wanted to high five everybody on the jet?
You know what? Gosh, there's so many, Chris. That's such a good question. I'll probably give you a really bad answer because it deserves.
You can take a second swing at it.
It deserves more time. But you know what? As I think back about it, I just think about the culture. And, that's a really intentional word for me, is the culture that we had and the esprit the core we had, not just with operating partners, that existed, of course, but in the kind of core building team, the M&A team, the finance team, those that were involved with capital sources and rating agencies and all of that, even the legal resources to do all of that. Was significant. And so to me, the most important moment in this company's history that most people, given the size of the scale of the business and the time that's passed, probably don't recognize or even know or attach any value to. But the single most significant moments when we did the management buyout in November of 2016. Because at 13, I partnered with a private equity fund to start growing at real scale. So a legacy lifestyle business became a real business. Partnered with a private equity fund in 2013. Great partners. We went from 10 million of EBITDA to 220 million of EBITDA in 3 years, so 22x in 3 years. They were high-fiving in the hallways and in the PE fund out in San Francisco. They were high-fiving on a regular basis. I was having conversations with them though about investing in data analytics and technology, and now buying bigger deals, going international. And they were like, not really sure that we really want to do that. And so I said, look, I think we've probably hit that crossroads, as good as the partnership is, that fork in the road to where you want to stay on one path and I want to go build the company that I think is sitting there waiting for us to build. And so we were out in Scottsdale, Arizona, had 225 people in the room, which sounds like a lot of people. It's a small gathering for us now, but 225 partners in the room. I stood in front of them and said, guys and gals, we're selling the company. There was an audible gasp, like, what? And I'm like, hold on. We, meaning all of us in the room, are going to be the acquirer. And so we're going to do a management buyout.
I love it.
We're going to take out our private equity investor. Now, I do have to have an outside party come in and be an investor with us. But when it's all said and done, we're going to own the majority of this business, and I'm going to control the board. And so that's when, and in order to get the transaction done, and this is again back to alignment and relationships 100%. And partnership, in order to get the deal done and have the company come in with, at that point, about $2.9 billion was the transaction, but come in with almost $1 billion, $990 million. It went from, it'd be nice to see 75% of all of you roll your equity. When I say roll, all of you roll your equity, but 75% of the equity that you have. So the aggregate 75% equity roll. Went from we'd like to see that, to actually a requirement of the transaction. So I had to go to all the partners with a pile of cash sitting on the table and saying, look, well, this is early innings. We can go do much more than what we've done. Let's bet on ourselves here and roll forward. And they're like, okay, we're in. I said, well, here's what it means. You can take 25% of your chips off the table, but you got to push 75% into the middle of the table and re-up. And to everybody's credit, mostly those folks, they did it. And so that changed. And this is, again, what I think people don't really realize, especially newer folks that maybe have come in the last 3 or 4 years, is so what that gave me the opportunity, and our M&A team the opportunity to do, is if you're sitting down with an M&A prospect and you're a private equity fund-backed company, or you're one of the public brokers, you're telling a story and presenting, kind of storytelling about what life's going to be like after the transaction. Yeah. The reality is we could walk in a room and said, you know what, you really can't believe them because they're private equity backed, they're private equity controlled, they're probably flipping in 2 years, and so who knows what it's going to look like. So they might be able to tell you what the world's going to look like in 12 or 24 months, but there's no way they can tell you what's 5 years. They don't control anything. The public brokers, what that looks like. They're public companies. And so we were the only company that said, look, if you really want to kind of bet on the future, have some predictability about what that future is going to look like, there's really only one party you can do a deal with, because we own 70, I think it was when we closed, 75 or 76% of the company. We own that percentage, and I control the board. And so you don't have that dynamic with anybody else in the marketplace, because at the time that management buyout was done with a preferred equity structure. I won't get into finance terms, but it was a preferred equity structure which gave us the opportunity to, yes, as an investor, your money's being put in front of us, but the trade-off is I get to control the board, and we own 75% of it. And so so then the value creation started accruing, I'll say, to the people that really should get the benefit of all this growth. And so what all that did, it not only allowed us to tell a different M&A story that was highly differentiated and we could paint a picture of the future that others couldn't paint, but it also, from the control of the board, I would tell you, and people even been around really don't truly understand it, but when we did the deal where we invested heavily in AI in 2020, we purchased an AI platform in 2020 for $400 million. When it came time to vote on that, I'll keep names out to protect the guilty, but when we come to vote on that, our private equity partners, which had 2 board seats with 1 vote each, I had the 3rd board seat with 3 votes, they abstained. They did not vote. I didn't vote yes, didn't vote no. I chastised them a little bit, said, look, I'd actually respect you if you voted no. You can't abstain. They actually abstained. And so I voted yes. And so our tech journey, our fintech journey, the product and service offering and all those things that we have today that are way beyond insurance brokerage. We're sitting here because of payroll and all the things that you and Vince and team all bring and are expert at and are terrific at satisfying client needs and all those things that you're doing in terms of solutions. All that got back to that management buyout in 2016 that gave us the opportunity to control the board, own the majority of the business, and as we're creating wealth, we're creating it more for the right people than say, just investors, those that are in the business every day. So when you ask a great question, what's the high five moment? It was probably more of a high five moment for me because I understood what all that was going to mean for us in terms of our future. And I'm not sure everybody understood that. But if you say in the company's history, what is the one moment where things change? And if you look at the business today, how did we get here? It all goes back to that decision to do that management buyout in November of 2016.
That's amazing. That's amazing. And if you really think about how that particular moment of the management buyout, getting the board seats, that was kind of the first major, it's a big investment for $400 million to go buy an AI company. In 2020, AI was nascent, right? Like it was so new. That is a big bet on a fintech path.
Yep.
Right?
Yep.
And that wasn't possible until that construct of and the storyline that you just gave. That's not possible. Talk to us a little bit about how the fintech financial technology company has evolved even from that.
Yeah, so very quickly, just the history of it is so no one thinks if we're documenting history here a little bit, we'll have some context to it. It wasn't a crazy bet, even though I had smart investors abstain from voting. It wasn't a crazy bet, and the reason of that is in 2019 we did a joint venture with that AI platform Tolco, where the thesis was could we roll out life insurance and voluntary benefits digitally, roll it out, identify clients, market to clients, sell, quote, bind, everything digital end to end, no humans involved. Wow. So that's what we set out to prove or demonstrate. We threw $25 million in. Thomas Toll and the Tolco team threw $25 million in. Built the platform. We had $50 million to build the platform. We built it in 2019, rolled it out in 2020. We're now in the middle of COVID. That business grew, and it didn't. If you said, "Can you do this digitally in the end with no humans involved?" And the answer is you can, but the scale is going to be really modest. It wasn't until we started adding humans into the right time. I won't even say in the sales cycle, but the right time of the sales cycle, that we got the growth that we did. And when we say growth, we grew. That business grew 10% or more per week for 24 straight weeks during COVID.
That's awesome.
So a half a year of 10% growth. So I called Thomas and said, Thomas, I want to buy out your 50% interest. And his answer was really predictable. Greg, it's growing 10% a week. Why in the world would I sell? And I just said, look, we don't do a deal now, I'm not going to be able to afford to do this later. And so that was the $400 million. Thomas, the smartest guy in the room, he took it all in stock. He took no cash. He took it all in stock, in Acrisure stock. And so the bet was made. The investment was made. The bet was made. And really, from those early days, the things that we could see that was available to us is client insight that was going to be game changing as far as what are the products and services clients will buy. What are they interested in? Being able to say, okay, if you have the profile of a client that looks like this, who else looks like this?
Yeah.
And so without an AI platform and some predictive modeling and ingesting, just unbelievable amounts of data, now well over 300 billion data elements that we have, 300 billion data elements we have. Without that kind of ability to comb through all of that and make sense of it, and have some predictive modeling, a human can't do it. It's just too scaled. It's too big. It's too, everything. And so at the end of the day, that really did change and pivot. And what I would say is that we got really good at seeing things and having access to things that others didn't have. I would say our execution on selling more products and manufacturing and having all of that manifesting in our financial statements. Modestly successful at doing that in the early days, getting better and better and better at it now. Our best days in terms of tech deployment, even though we've been at it 5+ years, our best days are still ahead of us as it relates to what we can do with technology and AI and data insights and perspectives. And so the business that we've built, definitely different from, say, insurance brokerage, definitely differentiated in terms of the tech that we have, the data and information we have, the tech talent that we have, highly differentiated. If you look at, the tech team, enterprise technology group, as we call them, if you look at them and the profiles of those people and compare it to any insurance broker in the world, it's vastly different.
Yeah, no doubt.
And so all to say, we've got still the makings of a differentiated growth platform that it's been underpinned by all of those early things that we saw in 2019 and 20, and just getting smarter and better about how we use the data and information now and the predictive modeling that we have.
Yeah. So, just to kind of help, set the stage for where you are today. You've got this acquisition engine that I would say at the point of starting to introduce technology probably started to slow down. You weren't doing 100 deals a year. Mm-hmm. And so you've got the deploying of the technology. So there's this, the way that the company is growing changed dramatically. Rather than just through M&A, right? It had to grow organically. And, the larger that you get, the harder that becomes. And I think that there was an inflection point that you really had to think through, okay, what do we really need to commit to, to investors and figure out sort of what the end game, is for this company. Tell me a little bit about like the headwinds and a little bit of the challenges of the organic growth game at the size that Acrisure, is today, but was at that point.
Yeah, you know what? I think all of these discussions are best started when you start thinking about clients first. And so when you look at the composition of our clients, 7% of every business in America is an Acrisure client, as we see here today. 98% of those clients have 100 employees and less. And so you think about a business that has a profile, 100 employees and less, the needs they have are significant. It's, yes, insurance, it's payroll, it's cybersecurity, it's, tax, wealth management, on and on the list goes of other things that the product and services, the payment processing, truly the list goes on and on. And so it's not tough to discern that those are the needs, because you know that they're buying them. What's a little bit more involved is, okay, they have those needs, but do they prefer to work with 12 different vendors to get all those needs satisfied, or would they really like to work with one trusted party if there was one trusted party? And that's the biggest thing I think that we've learned and understand about our clients, and why the pivot to fintech and using technology and the broad product and service offering and organic growth is we understand our clients, I think, better than most, willing to invest, evidenced by the $1 billion plus investment we've made in the payroll space, willing to invest in the things we know our clients want and need, They have spoken. We do know that 86% of them would like to get all of these product and services from one source if they could. They're just not a viable option right now to do that.
Exist
So when you start looking at all that, you have a company that's grown explosively, 48% compounded growth for 12 years. Mostly M&A. Now you got to organically grow it. The product
which is unlikely to be 48%.
It's not going to be. It's not even unlikely. It's not going to be 48%. So, can you get to a business of this scale, even that's high single digits? The answer is you can, and we absolutely should. When you look at the product and service offering that we are bringing to a client, is more than if you said insurance brokers. I mean, we've got more to sell than what they have. We have a client base that's perfectly suited to buy what we're selling. And so when we sat down with this broader view of the world and said fintech is really what, it's not just a name or a label, it's what we in fact have to go be and have all of the things you'd expect a fintech to have. Part of that's growth. And so if you're going to produce that kind of growth, I'll say high single digits to low double digits growth organically, the product and service offering has to expand. We have a perfect client base in order which to expand that. And the total addressable market, when you really look at what we can become as a company relative to, say, an insurance broker, I mean, the TAM of a financial services business versus an insurance broker is about 100 times the size in terms of a global financial services business versus a global insurance broker. It's 100x the TAM. And so am I saying we're going to be 100 times the size of an insurance broker? No, I'm not saying that. I'm just saying the opportunity to grow is significantly different and better and more expansive and prolific as compared to, say, if you just stayed in the insurance brokerage lane. So is this the pivot to fintech, the pivot to a broader product and service offering? Does it make sense for all stakeholders? It absolutely does. And even if that was true, and you had the wrong client base, while that might be true, if you get the wrong client base, you got misalignment. We got perfect symmetry in that we have this belief and this opportunity with a client base who's asking for us to kind of fill the gap. And so that's the growth. Yes, it's got to be more organic and going to be more organic in terms of the growth of the business going forward. Partners are still referring in abundance, compelling M&A opportunities around the globe. When, some people ask, well, how in the world do you get to 24 countries? Because, for me, a little over 12 years ago, we were in 3 states. 3 states is now all 50 states and 24 countries. And I go back to that alignment and those partners and so forth is that all of that, geographic spread, if you will, is come through word of mouth. It really isn't because we've decided to, I did intentionally go to the UK in 2017, met who's still on our exec team today, Graham Millwater, and at the time Beach and Associates, which was a reinsurance broker. Not everybody understood the logic of investing in reinsurance, but it's something that strategically is very important to us as we sit here to this day. And so I went with the introduction by one of our bankers. I said, look, I want to start looking internationally. You're an international global bank. Do you have relationships in the insurance space across the pond? And so he gave me 8 names to talk to. One of them was Graham Millwater and Beach and Associates. And I didn't necessarily go over there to acquire anybody. Just went over there to learn about the marketplace and understand. And just met Graham and that team, and kind of the rest is history. So I met them in 17. We did the deal in 2018. They were $40 million of revenue when we bought them. They're $200 million today. What is it? 6-7 years later, all organic, 40 million to 200 million. So they've grown 5x. And so all to say, stitching this together that we have from the outside looking in, maybe looked fast and maybe reckless, but it was very intentional. Strategically, there was a purpose behind all of it. It's very, very acutely aware of capital that we had raised and making sure we're putting that capital to the best use to grow the business and invest in things like technology that was going to, kind of seed the future for us as well. So that's kind of how it all is, stitched together. But to your, long-winded answer to a short question, organic growth does have to be kind of the thing you become known for.
Yeah.
You can build a business inorganically through M&A, but if you're going to sustain and have something that lasts, 50 years in the future, you got to organically be able to grow.
Absolutely. I mean, it's the big thing is you found a way to acquire customer bases, and then expanded, into the fintech space to be able to do that. And now the next capability that's really got to be sort of the volume's got to get turned up on is how to sell more products and services to that acquisition model, not just acquiring companies, but acquiring customer bases.
Yep.
So that's huge.
Well, one of the things I've talked about this, and again, it's kind of lost in the magic of numbers. When you hear 38 million to 5 billion and all that, the 48% compounded growth for 12 years and so forth, people do tend to focus on revenue and EBITDA. The reality is, and I've been saying this for 7-8 years now, is we're acquiring revenue and EBITDA, yes, but we're also acquiring data, information, and clients. And now, as you think about 7% of every business in America, 98% of them 100 employees and less, we've got a client base that yes, we bought revenue and EBITDA with those businesses we acquired, but those clients that were part of that, to say it's overlooked, it sounds, no, I mean, it can't be that, the number of clients you're acquiring every time you do an acquisition, people, of course, focus on, they don't. And so I'm just sitting here watching the number of clients, knowing the data and information that we're getting with all of those clients in each transaction. Someday was going to be more valuable maybe than some of the transactions that we did in terms of a like-for-like comparison. So we are sitting on massive amounts of information about the marketplace, massive amounts of data about clients, using AI and technology to start kind of how do you put all this together and identify your greatest opportunities, propensity rank them so you can be efficient in how you go after things. All that's part of what's been done, and again, why the fintech narrative is spot on.
Yeah, it's good. Well, we've talked about a lot of things today. Talked a lot about character, a lot about telling the truth, a lot about showing up, a lot about there's the motion and transactions of doing business, but it means so much to me that you unpacked what was really going on behind the scenes and told us, some of the things that I don't know if people, there's not a lot of people wired like Greg Williams, to go grow at that sort of size and scale. But there's a ton of people that listen to this podcast, and many that don't, that are running businesses, and to sit and reflect on what you do in business and how you show up in life. They are absolutely connected. And I love the way that you have shown up, in business and how you've shown up for the community and things like that. And I got one question that that's been on my mind since, we first started talking about doing the podcast. And it's basically, if you were to talk to your 14-year-old self right now, what would you say to him?
Something that I had to learn as well, and this is actually one of the questions that one of the easiest questions you've asked, and the reason I say that is I've given what I'm about to say that would be advice to my 13 or 14-year-old self. I've given this advice to 13 and 14-year-olds, and I've been fortunate enough that I've had friends and others reach out and said, "Hey, would you spend time with my kid?" And, whether it's a lunch or whatever, and talk to them, not about behaviors or anything else, just about how to think about a career and how to think about, opportunity and so forth. So I actually do that, and I enjoy doing that because you always learn something about the person you're talking to as well. But my counsel and advice to them isn't anything about, emotional, success or anything of that nature, that if you're ambitious in any way, whatever that ambition means, for me it was business success, but whatever your ambitions are, find people that have achieved extraordinary things, not someone from your neighborhood, unless you live in a really unique neighborhood.
Yeah, yeah.
But find someone who's achieved extraordinary success, and don't necessarily emulate what they did or necessarily what they do. Line of business or things of that nature. Emulate how they think. As I frankly have always done this. I didn't even know I was doing it. But you get people who they're envious or jealous of somebody's success. I am the opposite. I'll celebrate your success. I'll celebrate somebody else's success more than I'll celebrate my own. It's just a cool thing to see. What it takes to succeed, and people either figure it out and do it, or they get lucky. Whatever the case may be, it's usually not that. It's very, very, very seldom that. And so the advice is, find very, very successful people in whatever your field or interest that you have, and emulate how they think. And I have found that to be something that's kind of changed my life in terms of what is the art of the possible. And people say, have you had mentors? And I wouldn't say I've had mentors. I've had influencers. And it's people that, as I went and said, hey, I'd love to come spend time with you. And this is one of the other reason the advice I give people is that you think that ultra successful person won't spend time with you. The vast majority of them will. You ask them for a lunch, you ask them for a dinner, you ask them for 20 minutes, in their office. I've yet to have anybody say no to people. I'll say, look, if I were you, I'd go talk to them, and I can tee it up, but it'll mean more to them if you actually approach them yourself. And It's not something that I tee up. So I coach them to go do it. I advise them to go do it. And to a person, the ones that have done it, they've come back and go, wow, I learned something. And so again, it's not go chase their dreams or chase their life. Just get into how they think, because those folks that have been ultra successful just think differently than most people do, and some of it's they think different. Some of it they have a higher level of sacrifice and commitment and all of that, and maybe risk tolerance and other things that come into that. But that's the advice that I'd give myself, and I've found myself giving them similar advice to 13 to 25-year-olds, frankly.
Yeah. Well, one of the other things that I think would be really interesting, that as you were talking about, because you were like, hey, my success that I had chose was business success. What would you say to an entrepreneur that's going to go make their first acquisition?
Go into it with your eyes wide open. But first and foremost, and again, depending on if you're buying a widget factory, relationships don't matter. In the vast majority of things that you're going to invest in, people are part of the equation. And in prioritizing those people and investing time in terms of the relationships you have with them, that's going to come back and pay multiples over. And when you say, how does that all manifest itself at Acrisure? I'll just go back to 90+% of the acquisitions we've done come on a referral from an existing partner. So whatever it is that we did in terms of how we treated them as a partner, or if we told them we're going to do something, we did it. If we said we weren't going to do something, we didn't. All of those things manifest itself in someone saying, you know what, I'm actually going to take a friend, or maybe it's a competitor, but it's a friendly competitor. I'm going to advise them to come join the family. And now, was there some selfish motive and they're a shareholder? Sure. But at the end of the day, our partners, that relationship building and investing in that, I'd tell, if you're going to do M&A, think about that at the first and foremost, because even if you're buying, I'll say, the widget factory that has no employees, someone's important to that equation. There's a group of people that are important to that equation. So figure that out. The people side of it is something I'd prioritize. The integrity of people, the quality of character, all of those things come to bear. And so the money side, in terms of having the money to go do it, will follow. Compelling, business thoughts, ideas, etc., and the alignment with high quality, high character people. Money will follow because it'll also recognize the same qualities. And so those are the things that if you're thinking about it, regardless of industry, prioritize some of those things more than matter. And then obviously strategic relevance and, as an industry, obsolete or not, all that stuff comes into play. But if you check all those boxes, the people side and the skills associated with that and the integrity and the quality, everybody wants to be around good people and money, partners, etc.
Well, for the guy that only has one speed, let's go. What's next for Greg Williams?
Keep building. We got to keep building this business. I get asked all the time, what inning are we in? And using a baseball analogy, I mean, honestly, we're in the third inning. We got a long way to go.
That's awesome.
And so, keep doing the things that we're doing better, doing more efficiently, lean into technology. All of those things are part of that. I have other, things that I want to do before I'm dead and gone, and not to be morbid, but before I'm gone. And when I say that, businesses and things that I think have opportunity that I'll seed and do things off to the side that I'll do that are interesting, kind of personally of interest. But first and foremost, it's take what's been done in all the tremendous work by a lot of people and recognize that we're in the third inning. We got a long way to go.
Well, Greg Williams, thanks for coming all the way out here, for spending time with me and time with us and sharing all of the things that you did. Appreciate you getting super personal and helping us, really see some things about you that I don't know if a lot of people, get that kind of window into your life or into, people at your caliber. But thank you so much for coming. It was awesome to have you.
Chris, thank you. It's great to be here and nice job on your part.
Oh, thanks, man.
Yep. Bye now.